Welcome to this second episode of the Impact Principles webinar series. My name is Diane Damsky, and I head the Secretariat for the Operating Principles for Impact Management. The operating principles are a standard for investors to ensure they incorporate impact at each stage of an investment. They also provide a forum to convene ideas and actions to mobilize more capital for impact. In today's webinar, Impact Investing in the Era of COVID-19, we will examine the challenges and the opportunities that the pandemic presents to investors and discuss the on-the-ground realities of impact investing in these very unusual times. I am pleased to introduce our panelists today who represent three of the signatories to the Impact Principles. Sade Duffy, Director of Impact Management and Impact Investing at AXA Investment Managers, Roshni Bandesha, Associate Director of Impact Labs at Leapfrog Investments, and Tony Berkeley, Vice President of Impact and Responsible Investing at Prudential Financial. Now I'd like each of the panelists to say a few words about themselves and their firms, and then I'll review how the event will run before launching into the topic. Sade, let's start with you.
Thanks, Diane, and hi everyone. It's really good to reconnect with members of the operating principles and potential members too, because we've all been working in a new environment. So I'm Sade Duffy. I'm Director of Impact Management at AXA IM, and just a brief word about our firm. So we're a mainstream asset manager with assets under management of just over 800 billion euros. And in that typical style, we invest in the range of asset classes that you'd expect an asset manager of our size to do. And this is what's relevant in the context of this discussion, is that in 2012, we established an impact strategy with two clear objectives. One, of course, financial returns, but also we have an objective of generating positive outcomes for underserved people and the planet. It is this strategy that signed up to the operating principles, and the discussions for today, I'll be giving it within the context of that strategy.
Thank you, Sade. Roshni, would you like to introduce yourself?
Absolutely. Hi, everyone. Great to be connected over webinar, and I sincerely hope this is one of the last webinars we have to do and we do get to end up meeting in person. But nonetheless, thank you, Diane, also for including Leapfrog in this conversation. As Diane said, I'm Roshni Bandesha. I lead the impact management practices within Leapfrog Investments. We are a traditional private equity fund, but we are very much focused on the profit with purpose synergy, which for us means that in the pursuit of creating high impact, you also can create high profitability because there is a synergy between the two. And impact for us is very clearly defined as reaching people who are living below $10 across emerging markets. So right now we reach about 200,000 consumers in total, and about 165 million of them, are people who are living below $10 or fall within the emerging consumer category of Leapfrog. We're reaching them through 28 direct investments that we've done across financial inclusion as well as healthcare. And furthermore, our companies are also huge job creators. So we create about 132,000 jobs across the portfolio. And COVID has had some interesting impacts on that perspective as well. So I think what we will be covering is a bit of that, but please do send across your questions.
Great, thank you, Roshni. And Tony.
Hi, Diane. It's a pleasure to join today. I'm streaming in from the New York City area. And Diane, as you know, we're still in our summer period here in the US as the formal end comes next week with our Labor Day holiday. So it's a little bit of a lull, I think, between the very end of summer and the fall. This is a wonderful topic. It's one that's on the minds of the team I'm on at Prudential. So just a word about Prudential and the impact and responsible investing team. Prudential is a Fortune 50 global financial services firm. Probably our best known product was our original product, which is life insurance, but the firm now manages trillions in third-party capital in addition to providing investment, retirement, and protection products. The impact and responsible investments team is a team that manages a portion of the Prudential corporate account. So we don't manage third-party capital. We manage Prudential's own capital. It's $1 billion portfolio, or $1 billion portfolio. And it's majority deployed in the US, but there's also significant investments in emerging markets. Our main themes are workforce, or the future of work, education, financial inclusion, as well as urban transformation and affordable housing. We have been implementing the operating principles for impact management about the same time that COVID hit, maybe beginning a little before. And so the topic and the experience of COVID is something that was very much on our minds when we did our implementation. We feel pleased to have completed the first disclosure in July. And one of the things that makes Prudential's perspective not exactly unique, but somewhat different, is that I think we're one of 3 signatories that are true asset owners, in the sense that we don't manage any third-party capital. So our main motivations here are a kind of an internal sense of purpose at the corporate level in alignment with our values, and just a desire, I think, to implement a world-class, high standard of impact management, again, for our own purposes. We're not third-party fundraisers.
Thanks, Tony. So we have, as you can tell, we have 3 incredible panelists with us today. Just a few housekeeping items. Everyone has been placed on mute for the webinar. You may submit questions through the Q&A function that you see, and we hope to reserve some time for them at the end. There's also a chat function, so feel free to use that as well. So panelists, let me remind you also to please put yourselves on mute when you are not speaking. So now let's get to the topic. We've all been living a somewhat altered existence much of this year, and we've witnessed the economic toll that the pandemic has had and continues to have. You all saw probably the India GDP numbers that came out showing a GDP drop of 24% based upon the last quarter results. So the pandemic is truly having some devastating impacts. There's been a good deal written about the need for impact capital to respond to COVID-19. Multilateral development banks, or MDBs, and development finance institutions, or DFIs, have already stepped up to provide additional resources and support to their borrowers and investees. But it's clear that private sector capital will be needed to rebuild sectors and economies and support structural changes across businesses. Economic crises almost always prevent attractive investment opportunities. The dual crisis of public health and a struggling global economy has shone a light on many sectors and the urgent need to build solutions. But at the same time, investors may have to deploy additional capital to support their existing investments in current investee companies. So we've got 3 great panelists to describe their experience navigating the markets during COVID, and also discuss how the impact principles have helped support them in doing so. And with that, let me pose the first question. So Sade, I'll go to you first, but this again is an interactive discussion with all the panelists, so feel free to jump in as you like. So Sade, how has the crisis affected your implementation of the impact principles? So in what ways have they supported your ability to navigate the markets? And it would be interesting to know if you find that certain principles are more relevant than others in the current market environment.
Okay. I think before focusing on specific principles, I think I'll just give a general overview of how we're dealing with this crisis as impact investors. So we established a strategy to be differentiated. But what COVID has essentially reminded all of us is that even impact businesses are real businesses. For mainstream investors like ourselves, the fact that we're navigating COVID is the same way our mainstream colleagues are also navigating the impact of COVID. Then in that sense, you have to ask yourself, what really makes us differentiated? And I think when we stepped back and looked at it, it's really about a reminder of what our strategy is. That what differentiates us from mainstream investors who may only have one motive in terms of the objectives regarding investment is that we were purposefully set up to really tackle some of the world's most challenging circumstances out there. And COVID is just one of those issues that impact investors have had to tackle. This is the immediate challenge. But in terms of why our strategy was set up, and this goes back to principle one, where we're clearly defining what our strategic objectives are, we cannot make short-term changes. We have to continue to be that provider of long-term patient capital and to always have the beneficiary's voice in our head as we define, implement, and modify and adjust the strategy in line with the current crisis that we are facing. So what does that mean? In terms of how we respond to our direct investments, but also to the fund managers that we do our indirect investment through, it's about being very conscious of that long-term goal. This is not the time to make short-term decisions, just looking at things from a financial prism, even though we cannot ignore the financial aspects of our investment, but having that impact at the core of how we think about challenges and how we really put together solutions has really guided us and differentiated us from those that just have one objective. The other thing that it's done, and I really think, I've always thought that principle one was the fundamental principle that guides us as impact investors, is really being very long-term in our thinking. So in terms of the strategies that we established before the crisis, we haven't changed them. So we have a fund that we established late last year, which is really about financial inclusion and provision of better health outcomes to underserved people. It is even more critical to continue to invest along those lines in these times. And Principle One helps our clients understand why they have to continue to support the strategy, because they did not take a decision to support an impact strategy from a short-term perspective. And really thinking about Principle One and the promise we make in signing up to Principle One has helped stabilize our reaction to this crisis. Now, your question is there one that we find more challenging? So I've said, I've mentioned being patient, being constructive, being long-term supporters. But in the way that we set up strategies, and it's a really core part of impact investing, we really have to think about the impacts that we will generate. And Principle 6 for me, it's, how do you measure, monitor? We have to adjust those sometimes. The expectations of the positive impact that will generate, do we have to adjust them in the short term? And this is actually not just about impact, because in order to derive impact, we have to look at the business aspirations, objectives, and challenges of the underlying businesses that we channel capital through. So those are things that we really have to manage carefully. If we really have to monitor and manage the expected impact of our investments at this time, we really have to be flexible in terms of how we manage our expectations.
That was a wonderful overview to dealing with this current environment. Roshni and Tony?
Yeah, happy to jump in. I think as Shadi was speaking, AXA is actually one of our investors. So the way that we've seen this come into play is actually on the strength of Principle One. As Shadi was saying, that Leapfrog, the reason why we raised fund was for a very specific reason, is reaching the emerging consumer with financial inclusion in healthcare products. What we and our investors understand is that the needs of the consumer changes. So you have to be ready to pivot in a way that you serve the consumer better, but you have to keep your ambition to be extremely clear that it has to remain within the emerging consumer strategy and how you grow that. So for us, the collaboration then has been keeping sure that Principle One remains same, but principles relating to Principle number 3, Principle number 4, Principle number 5, which is how do you actually assess, how do you manage the ESG performance, is what needs to be tweaked and appropriately communicated back both to the portfolio company and to the investors. So for us, I think those 3 principles have become extremely core in terms of how we channel our vision. And more increasingly now, the concept of the principle relating to responsible exits also comes into play, because we have looked at new deals. So that principle has already sort of been put into play and some interesting learnings. But how we exit during this time is going to be extremely critical as well. So, Shadi, thank you for raising those points.
Dan, I just wanted to underline Roshni's point about Principle 7. First of all the principles are critical at this time. There's significant pressure on our portfolios, and everybody's experiencing that differently. And I think what the operating principles for impact management put us in a good position to do is make decisions that are structured and rigorous around the impact consequences of those decisions. I think without the operating principles, the tendency would be to make not just finance first decisions, but finance only decisions. And I think the principles really provide that framework for these tough calls. And I agree with Roshni's point. I feel that operating principle number 7, the responsible exits, is I think maybe one of the more challenging of the principles for market participants to operationalize, period. But in this period, when there's pressure on liquidity and if refinancing is not an option, then exits become, one of the likely outcomes. And it's a challenging market for that. And it gives me comfort to know that Prudential and so many others have this strong principle guiding them in that. It doesn't make it easy, but I think it's important to have it as a signpost and a guideline.
Those were all great comments and examples of how the principles are really being integrated into the current environment. And principle 1 is, as you say, it's since you have a double bottom line that you're targeting positive social environmental impact alongside financial returns, it isn't the financial returns that are just going to drive the decisions. That patient capital is really focused on the impact. And for question 2, let me start with you, Roshni. Can you talk about some of the noticeable changes during COVID-19 in the markets where you're investing? For example, what I mentioned before is a lot of investors are finding that they're having to dedicate additional resources right now to current investments rather than thinking about some new investments. So how are you working with the current investees in this environment? And it would be wonderful if you could provide some real world examples.
Yeah, absolutely. So for us, our market performance is very much, as I said, emerging markets. And within this, for example, India is a key market for us. We've got Thailand, we've got South Africa, Ghana, Nigeria. So a lot of these, first of all, from a COVID impact perspective, the wave has come slightly later to these markets, and the government's response was very varied across these different regulations, which has actually led to severe implications, both positive and negative, for all investors at this point. For us, I think the main thing that we've seen is just the understanding and the commitment that we had, both from our investors as well as us, that we need to make sure that our companies where we have invested do get the fair share of support, whatever they require, in order to deliver on their promise. That's part of the reason when we started thinking about, do we do new deals or do we continue with the current portfolio? Of course, the current portfolio takes precedence because the new deals will only be successful if we are able to demonstrate both the rigor and the wealth of knowledge in our existing deals. What we've also seen across this portfolio of ours is the fact that, we looked at 4 things across all of them. We looked at how are you in your business continuity? Like, are you having some solvency risk? How are you in managing your customers? How are you managing your employees? And the last thing, what is the impact on your operations? And depending on where the emerging consumer company was, the impact has been and the work has been very different. So for example, from a business continuity perspective, India has been very severely hit, as you were saying. So over there, one of our key investments, which is Northern Arc, it's a debt aggregator, which provides capital again to microfinance institutions. We actually work with them to enable capital raise from international investors, because what we realized is the need for capital is going to be so great right now that we need to make sure that we have somebody who's much stronger as well as larger in order to come into the partnership to keep the work going that Northern Arc is doing on the ground in India. At the same time, what we were seeing is that the consumers are not necessarily moving away from the utilization of financial inclusion products. I think given the wave of financial inclusion and the education that has gone to, the work that we thought we needed to do more impactfully is to make sure that they understand how to use these products well now that the risks have actually come into play. And over here, one of our businesses, again based in India, FinCare, has been proactively reaching out to their own consumers, telling them, here's how you pay back your loan, here's what we can do, here's what the government is helping you do. Let us work with you, with our agents, to make sure that you get what is due by you. Then when it came to sort of the jobs impact, here we saw a very differentiated approach. Some of the companies that had been around and possibly lived through the SARS crisis were actually very aware of what happens when business continuity shutdowns, right? But there were some businesses for whom this was a completely new idea in terms of how do you manage your employee base? How do you take them digital? So just working with the management and having very open and honest conversations on how this is going to be restructured and how should you communicate even and give your employees the faith that they will be treated well and fairly and in the right manner during this time. So it's been a range of responses, and the most interesting thing is that a lot of our companies pivoted not their strategy, but their solution set. So one of our businesses is a genetic diagnostics business. It's the MedGenome. And the genetic diagnostics is very different from, for example, path diagnostics that we do. So what that means is how the customer interacts with the business and how they give their samples for testing are 100% different. So MedGenome then went down this line and said, we've got labs, we can make it happen. So let's actually go beyond genetic diagnostics and start doing COVID testing. And they've had a bunch of learnings in terms of, the customers, the way that they engage with genetic testing is very different. They'll have patience, but when it comes to COVID testing, I need to know now. So how do you help them in the digitization strategy? How do you get them to do that? As well as on an insurance portfolio side, our portfolio companies thought about, we already have a consumer base of insurance who's not going away. How do we create that additional layer of COVID protection that is also provided to the much needed consumers who are often on the front lines? So, working with them and giving them that customer education, which led to a natural uptick until the time that people were able to make sure that digital presence was working well. So those are just like a couple of examples from our portfolio and what we're seeing, which is quite varied, in fact.
That's a wonderful story about the genetic diagnostics company, and being able to pivot like that in this kind of environment that's going to help in the long run. Sade and Tony, I'd love to hear from you.
Okay, let me jump in. It's very interesting listening to Roshni as she spoke, because as she mentioned earlier, we are one step removed in terms of we've invested in some of the funds. And what we found is that having to balance, so we have this broad agenda to be patient providers of capital, but we've also had to take account of that within the context of saving the whole. So some of the things we've had to grapple with is when there is, we don't have an unlimited amount of capital, which businesses do we save and which businesses have to modify their strategy, and which ones do we give money to, or which ones we have to find other solutions in order to survive. And I think what's been interesting is seeing how different providers of capital within the impact spectrum, from the asset owner to asset managers to fund managers like Leapfrog, have had to grapple with this, because that's really facing the challenge in the real world. No matter what our broad aspirations are, we still have to really take sometimes tough decisions as relates to real businesses. So that for me has been an interesting part of this crisis, looking at the long-term strategy, knowing what our long-term objectives are, but having to make some immediate decisions. And I think what's also been interesting is this has been a signal about management ability. Roshni's examples are great. Great management, adaptable to current circumstances. Some of our impact businesses, of course, they have great aims and objectives, but you still cannot go away from management ability, and that has really brought it to the fore.
Sade's point about management quality and the pivot is just so right on. I think, look, the markets have been absolutely crazy and in unpredictable ways. And I'm reminded that we're not even, we don't know if we're at the halfway point of this crisis yet or where we are in all this. And it's been fascinating to watch this play out from the Prudential Portfolio, which includes a mix of direct investments in growth companies, as well as real estate projects, as well as a very robust selection of managers. So we kind of see it both as a direct investor working with management teams, and then we see it through our engagement with impact capital managers. And it's really been one of these things where I don't think anybody at the outset could have predicted where some of the positive impacts would be, and they're there, or where the negative ones. So for example, on the positive side, for companies or managers that have strong themes in ed tech and health tech and fintech, some of the COVID market dynamics are very positive. And they're not just positive in the sense of valuations going up. I think there's some of that as well, but they're driving, consumers are taking advantage of these virtualized services to do things in the past they may have done otherwise. And there's a lot of press around it, which means that the market is, is positive for investors that have dry capital and have investments in those spaces. And I know everybody's feeling that, and it seems to be a trend that's not just a US-based trend, but a global trend. On the other side, there's some elements of typical investing portfolios and impact that have really been hit hard. So for example, real estate, if you're a real assets investor in urban cores, there's a lot of uncertainty now about what's going to happen and future of work and demand that, it may not, may not affect you today, but it's going to affect you down the line. The small business segment in the US has been definitely impacted dramatically by COVID. And we have, for example, debt managers that specialize in small business lending. And although there have been significant government resources, it's a sector that, is very, very challenged and very fragile. And how long the crisis goes on matters a lot here. And the same, I think, is true of consumer. So if impact investors are supporting various microloans or consumer lending strategies, we're focused on folks that are in the more vulnerable segment. And these are the folks who are being hit hardest by COVID, no matter where you're at. And so we have seen some impacts from that in our portfolio. Just to create one little positive note, and then we can move on. So we do have a couple outliers from whom the crisis that COVID provoked was a great business opportunity. And to Sharda's point, they pivoted, the management teams really jumped on. I just want to mention one quickly. It's a company based in the US called Revolution Foods that provides healthy, nutritious school lunches, traditionally was their business. But now they've been able to expand that to family lunches, adult lunches. They're supporting emergency response efforts across the United States. And there's new populations of vulnerability and need around food security that depended, let's say, on sources of food and feeding that are no longer available or are now feeling the economic impacts of COVID and sort of being pushed into food insecure status. And in the US, at least, there's a very strong response around this issue. And this company, Revolution Foods, since mid-March, has been able to do 150% of the projected revenue they had for the year. They're a $200 million revenue company because they're responding to new entrants into this area of community feeding. And they particularly have a kind of product that works well here. It's a unitized packaged product that can be distributed from community centers or baseball stadiums or schools outside the front door. And it really works well under COVID. They were declared an essential business. And the management team has been scrambling, the workforce has been scrambling, but it provided for them kind of a double underline of the impact and mission that they have. They extended their impact, and it's really helped drive their business and their revenue. So there really are these kind of real different impacts that we see in the portfolio. None of it would have been predictable to me, at least at the outset. And I just would continue to add, and we're not near the end of this, so there's a lot more storyline here.
Now that's really interesting. Some of the surprising outcomes that you found in some of your portfolio companies. I don't know, Sade, did you have any kind of surprises in your portfolio that you weren't expecting?
The surprises, I think the example is how our healthcare related investments have really been able to adjust to this crisis. So we've had a number of investments actually working in terms of looking for a solution to COVID in ways that we didn't think that we knew they were in the pharmaceuticals business, but it's really brought to the fore some of the underlying research and R&D these businesses had that can suddenly, if you look at it a different way, could be a response to some of the challenges in terms of early testing, quick testing, looking for aspects of solutions to vaccines. And it's actually been quite, I think it's been very useful even at work to use those as an illustration of why impact capital is very important. Because if you look at the scale of some of these investments compared to, the scale of us as an asset manager, we're 800 billion. Some of these investments as little as 5 million, which, considering our size, it's small. But in terms of the quality, the depth, the importance of what they've been doing, we've been using that to really bring to the fore to those inside our company the importance of what the impact investing strategy is doing. So some of our investing companies have received money from the Pasteur Institute to continue the R&D into COVID vaccine. Some of them are doing testing. There's a lot of adapting the strategy to this current crisis, and it's been very refreshing to see.
Great. And it sounds like, Sade and Tony, some of the examples you gave there, and also you, Roshni, that there are some additional investors that are coming to support with resources to some of your existing investees. Is that something that usually happens, or are you finding there's a particular response just because of the pandemic?
I think it's a mixture of both. So we've always had we've always kind of worked in a coordinated way with other providers of capital, and not just providers of capital, because in the impact business, one of the things that is quite clear is you don't just need providers of capital. You need providers of a whole range of inputs and resources to make a better whole. And that is what we've been seeing. We've been seeing people step up, other organizations step up in terms of providing capital, and there's been a lot of collaboration at this point between organizations that would not necessarily collaborate because they thought the objectives were different. But this has brought to the fore that there are lots of organizations out there that have common objectives, and that we should all collaborate more.
Just to kind of emphasize Sade's theme of collaboration and then new levels of commitment and investment, Diane, is what I'm seeing, more than new investors. I'll just touch on that briefly. But, the research community around vaccines has done an extraordinary job of collaborating from the very first days of COVID-19 around sharing the basic knowledge and emerging science around the vaccine. And then you see this kind of collaboration now around vaccine development and testing and eventually manufacturing. So I think it sets a high bar for what collaboration looks like under these conditions, and it's inspiring. And I agree with Sade. I feel like I've seen a lot of collaborative, reciprocal, respectful market activity by the market participants. It takes different forms. Sometimes we're brainstorming together how we can address an issue. In other cases, you have real legitimate reasons for borrowers to request, say, an interest deferment. And there's been a lot of willingness from a variety of market participants to consider those requests and provide them. Some folks are just stepping up their game in ways that bring chills to my spine. I'll just pick out the Ford Foundation, but you could Gates Foundation and the multilaterals. There's a lot of folks out there. Ford, in addition to being an active investor all throughout COVID, which I think is a pretty big achievement, right? Because when COVID hit in March, a lot of us kind of went back and reviewed our portfolios and deployments declined. Ford has really been able to maintain a pretty steady pace, kind of against their priorities, and then made an announcement that I'm sure you all caught, but it came out maybe in June, that they're going to raise additional financing through a bond by issuing a bond, $1 billion bond, so that they can provide and respond more muscularly to the twin challenges of COVID and the Black Lives Matter movement, which both hit them directly on their mission and impact goals. And they were quickly followed by other U.S. foundations. And so I guess what I see is that's not necessarily a new impact investor. Ford's already a major impact investor, but they're stepping up their game. They're committing now at a level that's historic. I've been in and around philanthropy for 20 years. I've never seen a foundation in the U.S. take a step like that, even consider it. So this is a new day and a new era, and I think it's probably likely that we're seeing a lot more interest, and there will be additional, players in the market. That hasn't been quite as visible for me, just so much as some of the mainstays just stepping up their game and doing the work that needs to be done.
Dan, I think there's one part of collaboration that we haven't spoken about, maybe useful, is actually the collaboration we've seen on the ground amongst the portfolio companies. I think it just goes to show that, especially portfolio companies that have been with impact investors, whether it's Leapfrog, whether it's somebody else, they get a difference in their DNA itself. They start thinking about the impact on their customers or their employees in a much more integrated fashion than they did before. So what these guys are now doing is they are reaching out to their own network peers. If there's another manufacturer, if there's another provider or insurance, they're reaching out, they're having these conversations about a range of things which were not perhaps done before. How do we protect our employees better? You've got agents on the ground, I've got agents on the ground. How do we do this? Can I use your tech platform to do that or not, right? They're also then talking about how do you go to the government together. I think that was part which was done before, but now it's very specifically related to how do we protect this particular industry, given our market, and what are we willing to do to work with the government so that there is, preservation of value, both for them as well as to the customer, as well as to the government. And I think there's a lot of interesting things that we are learning because, oftentimes we talk about how do we get portfolio companies to naturally get interested in impact. This is that way. It's unfortunate that the scale has been so hard and we could have been much better prepared, but you definitely see people setting up within these business communities and saying, we can do something about it.
Thanks. I feel much better than I did at the beginning of the conversation. These are very uplifting stories about people really coming together to take action to help everybody. So, as you mentioned, Tony, there's been a great response from foundations, notable response from MDBs, DFIs to address the impact of the pandemic. We all know there's still a need for patient capital to address the long-term effects. And I agree with you, Tony. I think we're just in the middle. Hopefully, we're a little past the middle, but who knows? But so, Tony, do you see any changes in how the market is perceiving impact investing now that we're in COVID? And you mentioned you might be hearing from some new investors and newer categories of LPs, but I'd like to hear what's your perspective from the asset owner community in general? Are you seeing a shift on the view of impact investing?
Dan, it's a fantastic question and probably deserves a little more time and depth than we can give it today. I mean, it could be its own panel and you could bring in different perspectives on that. But I'll tell you that the question itself occurred to me as well and to others in the spring. And so I collaborated, I guess to use our word today, with a group of other impact investors, and we put together, in effect, an open sourced market survey of what we saw going on in impact through the end of June is when the survey was done. It's a short PowerPoint. If Saradia, if she wants to drop the link, if she still has it into our Q&A, it's an open source, steal this PowerPoint kind of resource for those of you who are courts members like myself. It's meant simply to kind of create a little bit of intel that's impact investing specific versus broader market intel, of which there's a ton. What we found when we did the surveys, we looked by asset classes, and we found there was a kind of a really different story by the different asset classes. The big, great positive story was in fixed income. And to your point, what the development banks and some other large institutional players have done immediately in response to COVID, beginning in March, April, and May, releasing billion dollar plus benchmark social and sustainable bonds directly addressing COVID was extraordinary. The bond markets in general took off. So there was a lot of activity. Pricing is very low for investment grade bonds. A lot of folks entered the market. And there were just some amazing issuances. I'll just mention two. One was Guatemala, which issued a COVID linked bond very early on. And I know some institutions who did purchase and hold that bond. And again, those proceeds are going to be used in Guatemala, a country that needs that kind of capital infusion to help beef up their response. The European market was very active, and we saw interesting things in places like Indonesia as well. So that market took off. The response was strong. It was institutional. It's continued to a certain degree through the summer. I think in the other asset classes, so private credit, private equity, and I'll come back to the listed equities because I think it's an interesting case. But I think the reaction's been a little more muted. What we've seen, for example, amongst impact capital managers are, if you've got a thesis that ends in tech, health tech, ed tech, fintech, whatever the tech is, you're liking this. And if you're raising a little more dry powder and you're going after it. And good on you. And we also saw some generalist VCs take on the language and stance of an impact manager and go after some of these same themes. And everybody can decide on whether that's impact washing or not, but it was certainly opportunistic and appropriate. In private credit, the market exploded in a way that I don't think anybody could have predicted. There are more than 1,000 blended finance funds globally providing lower cost debt to primarily small business and NGOs. And it's an extraordinary response to COVID. If you go to covidcap.com, it's a database that's maintained by the Case Institute at Duke University here in the US. If you spend time, as I have, there are literally 1,000 funds. And if you look in the US, I don't think there's a state or a county that doesn't have one of these funds of some kind in the US. Many cities do. Many other countries have done this. Looks a little different by region, but it's an enormous amount of private credit, all being priced at, highly responsible, likely below market levels, flowing into the sector. It's not enough, clearly, but the response has really been there. And then if I turn to the listed equities, to the public equity space, I think the narrative that we're all probably familiar with is responsible investing strategies, sustainability strategies that are ESG based, have had a very strong performance track record into COVID. And there's been a fair amount of journalism on this point, comparing in different ways. Probably some secondary studies are starting to come out now, which is fantastic. It's sometimes confused with this more technical definition of impact investing, which is, really about providing capital to fund solutions. And so I don't think it's the same thing, frankly, as what we're talking about here. And then the other thing that I see, and we all see in the US at least, which is a stock market that's becoming increasingly, weighted towards a few large tech companies, which are doing very well under COVID. Thank you. Apple doubled their market valuation, I believe, in this calendar year. And they're one of the giants. And it feels a little disconnected from what's going on the ground, on the street. And it seems like it's not so much linked to the kind of impact challenges and flows that we're focused on. It really is a different kind of dynamic. So that's overall what I've seen. I think that there is probably an opportunity here, and I've seen some initial research from Morningstar that shows there are new flows coming into the space. This is to your point, Diane. The challenge is definitional, though, and until we get a clearer sense of what Morningstar means by impact, I think what they're counting are these sustainability bonds and these ESG, growth and income strategies. So while it's not bad, it's good, it's important, it continues a trend. It's not necessarily, I think, the kinds of things that we're focused on, where you're really tackling a problem and your capital is directly addressing, a solution potentially for that problem. I don't know at that level what the flows look like. I'm not sure how you would calculate that at this point, but we're hopeful. And as David Banks, the editor of Impact Alpha, says, suddenly everybody's an impact investor because we're all impacted by COVID. And that does suggest that long term that our way of thinking will be in a good position to continue to influence investment decisions.
Thanks so much, Tony. That was great. And unfortunately, this is probably not the first and last time that we will have to survive something as bad as this pandemic. It's just kind of the wave of the future. But I think you've brought some great examples to the fore of how you can mobilize resources to really quickly address it and then think longer term. Sade and Rashmi?
I'm still trying to get used to this mute and unmute technology. As Tony went through all the different flows of capital into the space, some genuine and some not, some I won't, some, we're still questioning their motivation, let me be diplomatic. I just thought that it's also important that we acknowledge the role that, truly private capital asset owners that are private in nature have played. So they're not development institutions and they're not foundations, but they've just embraced this language and responsibility of impact, and want to be genuine in the sense that they want to direct capital to the challenges that we're facing, and they're not shaken by the immediacy of what is happening, but they're looking at what they can do to help what we're dealing with, but really still thinking long term. And I wouldn't mention other names, but I'll mention the name of my parent company, AXA Group, because I have the license to do so, that some of our clients want to be private. But one of the things that's been really impressive is the fact that, asset owners have to deal with the current situation, also think about their balance sheet in the long term. But what this has really brought about is a continuing conviction of the importance of impact capital. So right now we're working with AXA Group to devise a program for the next $500 million investment in this intentional impact strategy. Because if you're a financial institution, if you're an insurance company like AXA Raise, you know that COVID signals a health crisis. AXA has been looking at health outcomes for the long time. It's part of its strategy. And it's also a health crisis that's going to lead to financial challenges. So in terms of its strategy around impact, that has not changed at all. But even beyond the health and financial aspects of what we're dealing with right now, it's also about being true to the risk that they see the world is facing in the long term. And while we're dealing with a health crisis and thinking about the financial implications of that, we also need long-term capital to continue to think about the climate crisis. And, we're dealing with this, but we really have to think, as Principle 1 reminds us to do, about the strategic objectives in the long term. So I just thought there's a lot of capital coming in, but those asset owners that really thought about their role in society are not reducing their efforts. They're actually doubling and in some cases tripling the allocation of money they're putting into this space.
Thank you, Shadi. I think, Dan, I won't have much to say beyond what Shadi and Tony said. I can talk about the capital flows, which is going downwards, investment into businesses and how that's showing up for us. So we actually raised our last fund earlier. We finished raising earlier this year. So our focus has been disbursement, but our disbursement has to be very specific, that within a 5-year period, you are able to go and create the value, create the additionality, have the impact, and come out. So what COVID presented to us was not necessarily a go or no go, that we're not going to invest anymore. It just meant that now that we need to disperse money, how do we pick out the actual true winners? Not only the true winners in the next 5 years, but somebody that we invest in and get them to build either the financial inclusion system or the healthcare system that is needed for long-term change. So we have very much kept sure that we stay within the growth capital area. But at the same time, as Tony was saying, what we're seeing naturally is the tech players are coming up more and more into the stack of where is your money going to go. And that is simply because they are able to leverage their position in reaching the consumers, as well as protecting the employees at the same time. What we have also figured out is that a lot of the businesses that were impact first or ESG first have weathered the storm a lot better they've come back to us to have a conversation, not from a place of, I would say, weakness, but from a place of strength. And personally, I find that to be a very positive attribution when a business comes back to you that, now we are even stronger than we were before COVID, because we were able to either tweak or get a better understanding. At the same time, the businesses that were either hyperinflated because of their names and they did not have the right operations, you have clearly seen that in emerging markets, they were able to go through the first 2 or 3 weeks and maybe like 1.5 months. But after that, that's where, things really start pinching. And they've had to either go for immense attritions, they've had to let go of their customers, And that's where you see, the true value can only be seen if you look at somebody's processes and how they live their day to day versus what the market believes them to be a leader. Because now that the rubber has hit the road, we've gone to see the small players, the tech focused impact first are the ones who are winning in a way, and are the ones that we continue to sort of think about deploying capital in even during the next couple of weeks or months.
Thank you, Roshni. So you've all stated that as impact investors, you've been focused on these issues for a long time. It's just recently become part of everybody else's daily conversations, because of the pandemic. So, financial inclusion, healthcare, food security, jobs, supply chains. And it does sound as if you're focused on that in your current investments, but given there's been a much larger setback in certain parts of the economy than others, do you think moving forward, you anticipate making any shifts in your allocations, maybe dedicating more assets to certain sectors or certain geographies? It might be hard to say that now because this is, again, long-term patient capital, but do you see anything just in the near and medium term as far as shifting of allocations? And this is for anyone.
Yeah, I do. Thank you for pinning me down on that. So these are kind of ongoing conversations that are being led by senior leadership at Prudential, members of the impact team. But I think what I see is that the impact tool can be used effectively in this environment to address some of the second order social and economic consequences of COVID. Even in sort of home geographies for Prudential. Prudential's based in Newark, New Jersey, so it includes Newark, but also the state of New Jersey. And I think we're still assessing what the vulnerability is here, but it's clear that in the U.S. context, that some of the government support systems and the flows and the financial vibrancy of state-based programs is going to be significantly hampered by COVID down the line. And so there's an opportunity and a need for investors of all kinds to think about what they do in that context and maybe reach out and partner with these state-based groups in ways that are even more, more direct and, more muscular than previously. And we're in the middle of those conversations now. Certainly on the philanthropic side, we've already made that pivot. But I think the impact side, it's a little bit of a longer conversation. I do worry, however, that there could be some shifting, right? As resources shift and attention shift, what does it shift away from? And I think as a sector and a community, to the point about climate change, I think we need to keep that front and central and find the right ways to balance this need to deal with some of the immediate first and second order consequences while not stepping back from these broader, longer term questions and challenges.
Roshni or Sade, would you like to add?
Yeah, happy to. So for us, I think our focus evolves as the needs of the low-income consumer evolve. So essentially, we invest a lot of resources in speaking or understanding directly from the consumer how they are experiencing their health impact, and that is generally very much influenced by what is going on in the market. And right now, you can think it's obviously COVID. So our consumers are changing their preferences, both in terms of what do they need in order to protect themselves and their households better. And so the way that we are thinking about the strategy is that we fully think that financial inclusion is going to remain a problem in the next 10 years as well. We need to continue on that focus. Healthcare, the way that Leapfrog thinks about specifically non-communicable and universal healthcare requirements is still going to be there. However, what we're going to start seeing is how we reach the consumer and how do we evolve this universal healthcare system is going to be extremely critical. So we don't think we need to necessarily go away from investing in sort of capital heavy investments. We only invest in asset light businesses, which actually bring the prevention to the consumer instead of waiting for the cure. And we're going to continue doing that. If that then also integrates communicable diseases, which we've typically sort of commingled or looked at, as a second tier to non-communicable diseases, we're definitely very open to seeing that. However, right now, as I said, focus is We've got 165 million low-income consumers. We have to make sure that they are protected during this time. And how do we maintain value for them?
Just echoing everything Roshni said or what Tony said, it's being consistent in terms of our strategy. You know, we spent a lot of time thinking about the right strategy that's aligned with our own core as a company, what we do, what we are, what we think our skills and natural affinities align with. And, you know, those long-term objectives won't change. You know, we'll continue to invest in solutions that tackle climate change and biodiversity. We'll continue to think about how we empower underserved people, whether through financial inclusion or healthcare. But as Roshni said, the delivery is what's important. That may change, but we're going to be stable in our strategy, and it's important to do so. You know, COVID it's an example of what the crisis that we have to deal with. Is just one example. We really have to think about how we improve health outcomes for underserved people, how we provide people with the financial resilience to deal with the challenges that they have to face, and ultimately, you know, the world in which we live in. How do we continue to preserve the health of the environment? Those are important things that won't change. You know, so tactics may change, but our long-term strategy will continue to be stable.
That's great. Thanks to all of you. And I know we're going to have to wrap it up soon, so I just wanted to just make a few comments about, you know, it really, you can see the difference with impact investors. The differentiator is that there is a mission, you know, the motives for your investing are different than someone who's looking just for financial returns, and the way you address situations such as a pandemic are very different. This conversation is very different than if you were just having financial investors around a table about how do you manage this so that you know, manage the downturn more. This is about how do you sustain the types of impacts that you are trying to achieve over the long term. And so I see the principles kind of operating throughout, and this is how you've been operating for many, many years. So it's heartening to hear that a lot of people are coming up to stepping up and making a difference, and that even, Roshni, you say your companies are starting to work together in a way because they realize there is this interconnectedness that you feel it much stronger when you are in a crisis situation. So I think these we can kind of take a lot of good hope or good thoughts from this conversation. I did want to let each of you kind of talk about as you know, ending comments on what's the one thing that you would like to see or hope for on the other side of this crisis. You've said a lot of positive things, but I think that, you know, for me, having people realize how everything that they do and everything that happens in their lives does have an impact. You see people, you know, just the job situation, even in my neighborhood, there aren't the jobs. It's affecting the communities. It's affecting the ability of parents to care for their children. It's just, it is a snowball effect that you see happening from this crisis. And I hope people remember that we are all very connected and that one action does, you know, affect everyone else. So for you, and I'll start with Tony, what would you like to see on the other side of this crisis?
Diane, I think you articulated it beautifully. It's this sense that impact investing thinking really matters in this context. What we do as a community really matters. These convenings matter. People turn to us for our advice, and our advice really matters. And it's not that it didn't before, it did, but I think it's even more visible, and I feel it more viscerally now. And I think that's very powerful. And again, it points to this future change in thinking where mainstream thinking begins to look more and more like what impact thinking is today.
I can go next. So for me, I think two things. One more professional, which would be actually getting the digitization agenda ready and off the ground for emerging markets. And I say this because COVID is going to end, right? But what we faced for years is the fact that traditionally low-income consumers are excluded because they don't have the right cell phone, they don't have the right app. And now you can see actually governments have come behind digitization and actually put into place that they can trace people The question is, if you were able to do it for this, surely we should continue it for financial inclusion as well as healthcare inclusion, right? So we are really supporting our portfolio companies like, it's hard, but get your digitization done now because this is the time for you. And the second is, I think, the personal reflection that I personally felt that, I was traveling a lot, going for different meetings. And the question is, were they all necessary? If we talk about climate change, if we talk about personal impacts, COVID has taught me that you don't need to be there for every meeting. You can be as impactful from where you are. So just more personal consideration of how can we all, as businesses and investors, also change the way that we behave.
I have 2 points, and it really relates to us as impact investors. I think what this has shown me, and what I think it's really important that we continue to carry past this crisis, is the beneficiary's voice in everything we design. We're not doing the strategies for our own end. There is a person, a community affected by whatever we do. And to think about, how we design products, how we interact, that beneficiary's voice, and really thinking whether the solution we're devising for them is constructive or not, and what happens if we take away that solution. I hope it's something that continues to guide us as we navigate this current crisis. And the second one is really reputation. What was really good internally and to our clients was for us to demonstrate the differentiation in terms of what we do. We now know that impact is a label, as Tony said, lots of people are using, and impact washing continues to be a challenge for our industry. Looking at things through the lens of our reputation has helped to reinforce the discipline of our strategy. And so that in terms of how we talk about impact, how we invest for impact, we should always have that at the back of our mind, that there are reputational issues at risk that will not only affect us from a maybe business perspective, but can also hinder the growth of our industry if we just label everything we do impact. And I think, when we look at our solutions that have been stable, continue to be able to, derive benefits to the ultimate beneficiaries, we can see which ones have been using the label and which ones have really been genuinely about creating impact. So 2 things at the forefront of my mind that I want to continue: putting the beneficiary's voice at the heart of what we do, and really, really challenging ourselves in terms of whether we're using the impact label appropriately to devise solutions.
Great. Thank you all. We did not have time for questions, and I will just note that there was a few questions on responsible exits, and you'll be happy to hear that the next webinar will actually be on responsible exits and how signatories are implementing Principle 7. It is very challenging, particularly in these times. But I just have to thank you, Tony, Roshni, and Sade. Thank you so much for an incredible discussion. And I feel so fortunate to be able to engage with the signatories and you and your colleagues, because this is an incredible group of organizations that are signatories to the principles. And I hope that all of you got a lot out of this webinar. There will be a link to the webinar on the website, and we may also be sending it by email, but please tell your friends to look at it, tell your colleagues. And again, thank you all. And I look forward to seeing you probably at another webinar very soon, but hopefully in person, sometime this year. So thanks, everyone. Bye-bye.
Thank you so much, Diane. Lovely speaking with you. Thank you.
Thank you, everyone. Really enjoyed today.